What you're witnessing right now has never occurred in the history of the modern Federal Reserve, and it confirms the exact terminal liquidity trap we have been warning about for the past 6 months. In the last 72 hours, internal Federal Reserve balance sheet data has exposed an unprecedented $31 billion emergency cash grab by Tier 1 bullion banks, signaling a total systemic failure in the precious metals short market. The evidence is undeniable. The same institutions that spent decades suppressing the price of gold and silver are now tapping the lender of last resort just to stay solvent as the metals complex goes parabolic. Look closely at the New York Fed S-System open market account filings for the week ending January 10th, 2026. While the mainstream media is obsessing over the televised political turmoil in Washington, a silent $31 billion liquidity flare was launched from the Fed's discount window, the highest single-week emergency borrowing since the peak of the 2023 banking crisis. But before we understand why this $31 billion injection is the smoking gun of a total gold market default, we need to go back to the hidden mechanics of how the Fed AS unlimited cash shift began. For decades, the global banking system operated on a fractional reserve gold standard. Since 1971, when the dollar was fully decoupled from hard assets, the playbook has always been the same. Bullion banks like JP Morgan and HSBC would sell paper contracts for gold and silver that they did not physically possess. This created a massive supply of digital metal that kept the price suppressed, ensuring the US dollar remained the only undisputed king of the reserve currencies. The banks knew that as long as the world trusted the dollar, no one would ever show up to the vault and ask for their physical bars. This system relied on one critical assumption, that physical demand would never exceed the registered inventory on the COMEX. From the London gold pool collapse in the 60s to the 2011 silver surge, the banks have always used a combination of high-frequency spoofing and coordinated media narratives to scare investors out of hard assets. But in late 2025, the game changed. Central banks in the East began buying gold at a rate of 1,000 tons per year, moving metal away from the Western vaults and into sovereign hoards that never returned to the market. The paper-to-physical ratio, which used to be manageable, has now exploded to over 400 to 1. The banks aren't just short, they are mathematically insolvent. On the surface, the mainstream narrative is painting a picture of controlled volatility. Official statements from the Federal Reserve suggest that the recent $31 billion in primary credit usage is merely a routine adjustment to help banks manage their year-end rebalancing, and the fallout from the Department of Justice is probe into Fed leadership. That is what they want you to see. But the real story is hidden in the Exchange for Physical, or EFP, data coming out of the Chicago Mercantile Exchange. Follow the money and you will see the contradiction. While the Fed claims ample liquidity, the CME was forced to hike margin requirements on silver and gold 3 times in a single week. Why would an exchange hike the cost of trading if the system was stable? The answer is hidden in the short trap. The bullion banks are currently on the hook for millions of ounces of gold they sold at $2,500 and $3,000. Now that the price is near $5,000, their maintenance margin calls are exceeding their liquid cash reserves. And here's the part they are not telling you. The Fed didn't just provide liquidity. On December 10th, 2025, the New York Fed quietly removed the caps on emergency lending for systemically important banks. This unlimited cash shift was designed for one purpose: to prevent a total force majeure declaration on the COMEX. The banks are using your tax dollars to pay for the gold they owe to the Chinese and Russian central banks. The game has changed. The $31 billion isn't a loan. It's a ransom payment to keep the paper gold market from vanishing overnight. According to Federal Reserve filings, the usage of the discount window is no longer anonymous. We can see that the borrowing is concentrated in the top 4 primary dealers. This is what they don't want you to know. The banks are using these funds to buy back their own short positions on the open market, which is fueling the very rally that is destroying them. We are witnessing in real time the collapse of the paper metals paradigm. This has never happened before in history. The evidence is undeniable. Follow the money, and you will see that the $31 billion cash grab is not a sign of banking strength, but a frantic effort to patch a multi-billion-dollar hole in the bullion bank's balance sheets. Here is where it gets interesting. The smoking gun is found in the internal settlement data of the Bank for International Settlements. For over 5 decades, the Western financial system has operated under the assumption that they could suppress gold and silver prices forever by flooding the markets with unallocated paper contracts. But on January 2nd, 2026, the East executed a structural checkmate. While the New York paper price was being suppressed by algorithmic selling, the physical premium in Shanghai soared to a record $9 per ounce. This historic price gap created a physical vacuum that allowed Eastern sovereign entities to buy paper contracts in the West, demand immediate physical delivery, and ship the metal east for an instant arbitrage profit. The bullion banks, led by JP Morgan's London desk, were suddenly caught in a negative gamma loop. They had sold hundreds of millions of ounces of silver at $30 and $40, and as the price shattered the $80 mark, their margin requirements exploded. The $31 billion they tapped from the Fed wasn't for liquidity. It was to pay for the literal physical metal they had promised but did not own. And here's the part they are not telling you. The Federal Reserve's December 10th announcement of a $40 billion per month liquidity injection into the system was the first white flag. While they told the public it was to support housing demand, the data shows that the majority of these funds were funneled into the standing repo facility to backstop the bank's silver and gold shorts. Without this taxpayer-funded lifeline, at least 3 of the top 5 primary dealers would have faced a Lehman-style insolvency event on January 5th. But wait, it gets even more calculated. The mainstream media is silent because acknowledging this liquidity crisis would reveal that the COMEX registered inventory is currently in a state of terminal decline. According to latest warehouse reports, the registered silver inventory, the metal actually available for delivery, has plummeted by nearly 12 million ounces in just 1 week. The banks are tapping the Fed because they have to buy physical metal at any cost to prevent a force majeure declaration that would end the paper gold market forever. The evidence is undeniable. We are witnessing the birth of a two-tiered market where the paper price is a desperate fiction and the physical price is the only reality that matters. The $31 billion is just the first installment in a ransom payment that is mathematically guaranteed to grow. As the short trap closes, the banks are no longer the market makers. They are the market's most desperate victims. This has never happened before in history. Follow the money, and you will see that the $31 billion cash grab is not a sign of banking strength, but a frantic effort to patch a multi-billion-dollar hole in the Bullion bank's balance sheets. Here's where it gets interesting. The smoking gun is found in the internal settlement data of the Bank for International Settlements. For over 5 decades, the Western financial system has operated under the assumption that they could suppress gold and silver prices forever by flooding the markets with unallocated paper contracts. But on January 2nd, 2026, the East executed a structural checkmate. While the New York paper price was being suppressed by algorithmic selling, the physical premium in Shanghai soared to a record $9 per ounce. This historic price gap created a physical vacuum that allowed Eastern sovereign entities to buy paper contracts in the West, demand immediate physical delivery, and ship the metal east for an instant arbitrage profit. The bullion banks, led by JP Morgan's London desk, were suddenly caught in a negative gamma loop. They had sold hundreds of millions of ounces of silver at $30 and $40, and as the price shattered the $80 mark, their margin requirements exploded. The $31 billion they tapped from the Fed wasn't for liquidity. It was to pay for the literal physical metal they had promised but did not own. And here's the part they are not telling you. The Federal Reserve's December 10th announcement of a $40 billion per month liquidity injection into the system was the first white flag. While they told the public it was to support housing demand, the data shows that the majority of these funds were funneled into the standing repo facility to backstop the bank's silver and gold shorts. Without this taxpayer-funded lifeline, at least 3 of the top 5 primary dealers would have faced a Lehman-style insolvency event on January 5th. But wait, it gets even more calculated. The mainstream media is silent because acknowledging this liquidity crisis would reveal that the COMEX registered inventory is currently in a state of terminal decline. According to latest warehouse reports, the registered silver inventory, the metal actually available for delivery, has plummeted by nearly 12 million ounces in just 1 week. The banks are tapping the Fed because they have to buy physical metal at any cost to prevent a force majeure declaration that would end the paper gold market forever. The evidence is undeniable. We are witnessing the birth of a two-tiered market where the paper price is a desperate fiction and the physical price is the only reality that matters. The $31 billion is just the first installment in a ransom payment that is mathematically guaranteed to grow. As the short trap closes, the banks are no longer the market makers. They are the market's most desperate victims. This has never happened before in history. This is what is actually happening. The $31 billion bank tap is not a simple liquidity injection, but the final desperate act of a dying paper gold regime that has officially lost control of the physical world. For decades, the mainstream media has acted as the PR arm for the bullion banks, dismissing the silver squeeze as a fringe theory. But on January 9, 2026, the facade collapsed when the Department of Justice served the Federal Reserve with grand jury subpoenas over its $2.5 billion renovation cost overruns. While the public was told this was about a building project, the reality is that the legal pressure was the trigger for a total regime change in how the global elite value the dollar. The real reason for the silence is that the Western banking system is facing an inventory zero scenario. According to latest COMEX warehouse reports, registered silver inventories, the bars actually available to satisfy delivery, have plummeted by over 70% compared to their 2020 peaks. On January 12, 2026, silver futures for January delivery settled at a record $84.61 per ounce. The bullion banks, led by JP Morgan's London desk, are currently trapped in a cash-only failure. If they cannot find the physical metal to satisfy the delivery notices hitting their desks, they are legally forced to declare cash settlement. This is the ultimate game over for the COMEX. The mechanism of the conspiracy is found in the unlimited cash shift, quietly enacted by the New York Fed in late December 2025. By removing the caps on overnight repo operations, the Fed essentially gave banks a blank check to buy their way out of their short positions. But here's the truth they are hiding. There isn't enough silver in the world to close those shorts. The $23 billion Fed injection you heard about was just the opening act for the $31 billion surge we are seeing today. Follow the money, and you will see that every dollar printed by the Fed is being instantly converted into physical bullion by Eastern central banks, effectively draining the West of its last remaining hard assets. Mainstream media outlets like Bloomberg and Morningstar are framing the record highs as a safe haven rally driven by the Caracas raid. They want you to believe that the military strike in Venezuela and the capture of Maduro on January 3rd are the only reasons for the price spike. But they aren't telling you about the physical premium. And while the paper price trades at $84, the actual price to secure a 1,000-ounce bar in the London or Shanghai markets is now exceeding $95. This honesty gap proves that the paper price is a total fiction designed to keep the masses from realizing the dollar has already collapsed. The villains of this story aren't just the banks, they are the central planners who have used your savings as collateral for their failed short bets. The $31 billion in emergency credit is being used to subsidize the very banks that are currently suppressing your wealth. The real story is that the East has called the West's bluff. By enforcing a dual license system for silver exports, China has essentially decapitated the U.S. industrial supply chain. The banks are tapping the Fed because they have to pay whatever price the East demands to avoid a total systemic default. We are witnessing in real time the end of the Donroe Doctrine, the assumption that the West can unilaterally control the world's resources through military force. The Caracas raid didn't save the dollar. It accelerated its demise by forcing the BRICS Plus nations to finalize their gold-backed settlement units. The game is no longer about investing in silver. It's about holding the only asset that the banks are currently trying to steal back from the public, using printed money. This is the truth the $31 billion was designed to hide. And here's why this matters more than anything else happening in the global economy right now. The $31 billion bank tap is the first major domino in a cascading collapse of the Western paper metal standard. If this trajectory continues, we are looking at a total decoupling where the official price of silver becomes irrelevant fiction while the physical price moves toward a catastrophic repricing. As of January 12, 2026, silver has already shattered the $80 barrier. But the mathematical reality of the short trap suggests that this is merely the launch pad for a move toward $200. The logical cascading effect begins with the industrial shutdown. Follow the money and you will see the trail. On January 1st, 2026, China officially implemented its new dual license framework for silver exports. This was the death blow to the Western industrial supply chain. By shifting from a quota system to a government-controlled licensing model, Beijing has effectively ring-fenced 10% of the global silver supply for its own domestic AI, solar, and electric vehicle sectors. The bullion banks in New York and London are now caught in a pincer movement. They owe millions of ounces of physical silver to their creditors, but the world's second-largest producer has just closed the door. This has never happened before in history. In the 1980s, the silver squeeze was driven by two wealthy brothers. Today, it is being driven by the terminal exhaustion of a 50-year-old debt system. When the COMEX registered inventory hits absolute zero, which the current drain rate suggests could happen by the end of this quarter, the exchange will be forced to declare a force majeure. This is the moment when the banks stop settling in metal and start settling in depreciating cash. For the investor holding paper silver in an ETF or a digital account, this means you'll be paid out in dollars that are losing value by the hour, while the physical silver you thought you owned is nowhere to be found. And here's the part they are not telling you. The $31 billion injection was a desperate attempt to shore up the maintenance margins of the top 4 primary dealers. Every time the silver price rises by a single dollar, the collective loss for these short sellers increases by approximately $400 million. At $84 silver, their unrealized losses are already exceeding $15 billion. The Fed is essentially printing money to pay for the bank's failed bets against a metal that the world desperately needs for the technology of the future. The geopolitical implications are even more chilling. This is the China versus West endgame framing in real time. By locking down their silver supply, the East has executed a commodity decapitation. Without silver, the West cannot build the next generation of 5G infrastructure or advanced weaponry. The East has realized that you don't need to win a war if you control the atomic building blocks of the opponent's military-industrial complex. The $31 billion is just the beginning of a ransom payment that the American taxpayer will be forced to pay to keep the lights on in a world of disappearing resources. For centuries, gold was king. Its glimmer promised stability. Its weight represented wealth. Nations built their economies on its foundation, with paper money being just a promise, a claim check for a piece of real, tangible gold or silver. This was the era of the precious metal standard, a time when money had intrinsic value. But what happens when that foundation cracks? What happens when the promise is broken? This is the story of a monumental shift in global finance, a quiet revolution that is reshaping our world. It's the story of the end of an era and the dawn of a new one. Let's rewind to the aftermath of World War II. The world's leaders gathered at Bretton Woods, determined to create a stable economic order. The US dollar, backed by the largest gold reserves on the planet, was crowned the world's reserve currency. Every other currency was pegged to the dollar, and the dollar was pegged to gold at a fixed rate of $35 per ounce. It seemed like a solid system, a guarantee against the kind of economic chaos that had led to war. For a while, it worked. The post-war world experienced an unprecedented economic boom. But beneath the surface, tensions were building. The United States, funding both ambitious domestic programs and a costly war in Vietnam, was printing more dollars than it had gold to back them up. Other countries, holding vast sums of these dollars, began to get nervous. They started to see the writing on the wall. The promise was getting harder to keep. France, under Charles de Gaulle, was the first to challenge the system openly. They saw the U.S. enjoying what they called an exorbitant privilege, the ability to print money that the rest of the world had to accept. So they started cashing in their dollars, sending warships to New York Harbor to physically collect their gold. Other nations followed suit. The gold was flowing out of Fort Knox at an alarming rate. The breaking point came on a quiet Sunday evening, August 15th, 1971. President Richard Nixon appeared on national television and made a stunning announcement. He was temporarily suspending the convertibility of the dollar into gold. The gold window was slammed shut. That temporary suspension became permanent. In a single moment, the entire global financial system was unmoored from its golden anchor. The era of fiat money had begun. Money was no longer a claim on a physical asset. It was backed by nothing more than faith and credit in the government that issued it. For the next 50 years, this fiat system dominated. It allowed for incredible flexibility, enabling governments to respond to economic crises by simply creating more money. But it also came with a hidden cost: inflation. As the supply of money grew, the purchasing power of each dollar, euro, or yen slowly eroded. Your savings became a melting ice cube. The system also fueled massive bubbles in stocks, real estate, and other financial assets, creating a cycle of boom and bust. We've lived through the dot-com bubble, the 2008 financial crisis, and the unprecedented money printing that followed. Each crisis required a bigger bailout, a larger injection of newly created currency, pushing the system further to its limits. Meanwhile, a different story was unfolding in the background, a story not of paper, but of physical things. While the West focused on financial engineering, other nations were quietly playing a different game. They were accumulating the raw materials that actually build the world. The copper for our wiring, the lithium for our batteries, the rare earth metals for our electronics, and yes, the gold and silver that had been cast aside. These nations understood a fundamental truth. You can print money, but you can't print oil. You can't print grain, you can't print copper. In a world of infinite paper promises, real physical resources become the ultimate store of value. Now, we are standing at the precipice of another great shift. The signs are everywhere. Geopolitical tensions are rising. Nations are forming new alliances, creating trade blocs that bypass the US dollar entirely. We're seeing major economies actively seeking to de-dollarize, settling trades in their own currencies, or creating new payment systems backed by a basket of commodities. Think about it. The world is electrifying. We need massive amounts of copper, nickel, and cobalt for electric vehicles and renewable energy infrastructure. Our digital world runs on silicon chips and rare earth elements. Our growing global population needs food and fresh water. These are not abstract financial instruments. They are the bedrock of the 21st century economy. The countries that control these resources hold the new levers of power. The value is no longer just in the promise printed on paper, but in the physical stuff you can pull from the ground. This isn't a return to the old gold standard. It's something new, something far more complex, a resource-backed economy. In this new world, a nation's wealth might be measured not just by its GDP or its gold reserves, but by its control over critical supply chains, its reserves of strategic minerals, its agricultural output, and its energy production. The balance of power is shifting from the nations that print the money to the nations that produce the things the world needs. What does this mean for you? It means we need to rethink our definition of wealth and security. The era of easy money and passive gains in a perpetually rising financial market may be coming to an end. The value of tangible assets, things you can actually touch and use, is likely to become more and more important. This isn't a forecast of doom and gloom. It's a recognition of a changing landscape. Every major economic shift in history has created immense challenges, but also incredible opportunities. The transition away from the paper-based fiat system towards a resource-backed economy will be no different. It will be turbulent, it will be disruptive, but it will also pave the way for a new kind of global prosperity, one grounded not in financial abstraction, but in real, tangible value. The world is waking up to the fact that you can't build a strong house on a foundation of paper. The future belongs to those who understand the value of real things. The great rebalancing has already begun. The question is, are you prepared for it? Thanks for watching. If you found this journey through economic history insightful, please hit that like button, subscribe to the channel, and ring the bell so you don't miss our next deep dive. We'd love to hear your thoughts in the comments below. See you next time.